In this video, we will walk through how Danish income tax works for employees, so you can understand what happens between the gross salary your contract promises and the net pay that reaches your bank account. Denmark is known for relatively high taxes, but also for a high degree of transparency and predictability, and the system follows a clear logic once you understand its components. We will focus on individuals working as employees, not self-employed professionals, and we will assume that you are fully tax liable in Denmark, meaning that Denmark considers you a resident for tax purposes and taxes your worldwide income. As an employee, your starting point is your gross salary, which includes your base pay, and any taxable benefits such as bonuses, certain allowances, and, in some cases, employer-provided perks that are not tax-exempt. Before personal income tax is applied, however, there is a mandatory labor market contribution known as AM-bidrag of 8%. This contribution is calculated on most of your earned income and is withheld by your employer before anything else. In practice, this means that your taxable income for the main personal tax calculation is your gross salary minus the 8% labor market contribution. Once AM-bidrag has been deducted, the remaining amount is subject to a combination of state tax, municipal tax, church tax if you are a member of the national church, and, for higher earners, an additional top bracket tax. Municipal tax is set by each municipality, and therefore varies depending on where you live, but it is applied at a flat rate to your taxable income after AM-bidrag and after deducting certain allowances. Church tax is relatively low and only applies if you have not opted out of church membership. State tax is split into two layers: a bottom bracket tax that most taxpayers pay, and a top bracket tax that only applies once your income exceeds a certain threshold, which is adjusted periodically. When your income surpasses this threshold, the portion above the limit is taxed at the higher top bracket rate, in addition to municipal and bottom bracket state tax. Denmark has an overall ceiling on the combined marginal tax rate on earned income, including municipal and state taxes, but excluding the 8% labor market contribution and certain special regimes, so that even high earners face a clearly defined maximum marginal rate. At the same time, the system is designed to offer broad-based deductions, with the personal allowance being the most important. Every resident taxpayer receives a basic personal allowance that reduces the income subject to bottom bracket and municipal tax, although this allowance does not reduce the 8% AM-bidrag. The allowance is granted as a tax credit, effectively reducing the tax you pay rather than the income you report. In addition to the personal allowance, employees benefit from an employment allowance, which is a tax credit linked to earned income from work. There are also deductions for contributions to certain types of pension schemes, interest expenses on qualifying loans, and some commuting costs, subject to distance thresholds and caps. These deductions lower the base on which municipal and state taxes are calculated, but they do not change your gross salary or the AM-bidrag itself. From an employee's perspective, much of this complexity is handled automatically. Your employer withholds tax at source using what in Denmark is called the withholding rate, based on data that the Danish tax agency, Skattestyrelsen, maintains in your preliminary income assessment. This assessment is the core of the skattekort, or tax card, that tells your employer what percentage to withhold and how to apply your personal allowance month by month. If your situation changes during the year, for example, a salary increase, a new job, a move to a different municipality, or significant changes in pension contributions, it is your responsibility to update your preliminary income assessment online. When you do this, Skattestyrelsen recalculates your expected total income, deductions, and tax for the year and issues an updated tax card. Your employer then uses this updated information for subsequent payroll runs, which helps you avoid large underpayments or overpayments at year-end. Each spring, you receive an annual tax statement that compares the tax you should have paid, based on your actual income and deductions, with the tax that was withheld. If too much tax was withheld, you receive a refund, often paid out automatically to your bank account. If too little was withheld, you will owe additional tax, which you can settle in a lump sum or, subject to certain conditions, in installments. For many employees with relatively stable income and few complex deductions, the system is largely automatic, and the annual statement simply confirms that everything is in order. However, for internationally mobile professionals or employees receiving equity compensation, stock options, or other non-standard benefits, the calculations can be more nuanced, and it can be helpful to seek professional advice or at least carefully review both the preliminary assessment and the annual statement. Compared with many other countries, Denmark places significant emphasis on digital self-service, so almost all interaction with the tax system, including viewing your income, updating your tax card, and checking your annual statement, is done online through a secure portal. For employees, this digital infrastructure means that transparency is high. You can see, in real time, the basis for your withholding and the buildup of your expected tax for the year. When considering take-home pay, it is important to remember that the tax system is closely connected to the Danish welfare model. The relatively high taxes finance extensive public services, including healthcare, education, and social security benefits, which in many other jurisdictions would either be privately funded or require significant out-of-pocket expenses. From a financial planning perspective, the most practical steps for employees are to ensure that their tax card reflects their current salary and situation, to keep track of major deductible items such as pension contributions and commuting, and to review the annual tax statement to confirm that the various types of income and deductions have been correctly reported. By understanding the sequence, from gross salary to AM-bidrag to taxable income to municipal and state taxes net of allowances and credits, you can interpret your payslip more accurately, anticipate your net pay, and plan your finances with greater confidence while working in Denmark.